EquityAxis News. Thank you for joining us as we broadcast live from our Hampton Court studios in the capital. My name is Caroline Chikerema. The International Monetary Fund has warned the Zimbabwean government that it needs to give autonomy to its central bank if it is to avert the risk of plunging the economy into hyperinflationary pressure after every 10 years. The institution pointed out that the current monetary crisis is as a result of failure to detach monetary policy from government policies. The functions of the Reserve Bank are to formulate and implement monetary policy directed at ensuring low and stable inflation levels. However, the contentious function of the central bank relates to its role of acting as a banker and financial advisor to and fiscal agent of the state. It is this function that has led to conflation between monetary policy and government policy. Zimbabwe's month-on-month inflation accelerated to 38.75% in October 2019, gaining 21.03 percentage points on the September 2019 rate of 17.72%. This is the highest inflation since July 2019, in which the inflation rate was 21.0%. Month-on-month inflation recorded rather surprising fall from a high of 39.3% in June 2019, with a downward trend continuing in August, 18.1%, September, 17.7%, until the recent spike in October. According to Zimbabwe National Statistics Agency, this means that prices measured by the all-item CPI increased by an average rate of 38.75% from September 2019 to October 2019. Zimbabwe Stock Exchange listed ProPlastics reported a 50% decline in sales volumes in the third quarter ended 30 September 2019 compared to the corresponding period last year due to subdued consumer demand. Purchasing power has been largely shrinking owing to runaway inflation as well as the continuous depreciation in the value of the local currency. Inflation rose to 353% in September 2019 year-on-year, whilst the local currency has lost over 80% of its value since reintroduction in June 2019. Further compounding business operational challenges is the inadequate power supply, which has forced many businesses to turn to alternative sources of energy, thus driving operating costs upwards. Electricity supply remains the biggest challenge in the third quarter, and the group had to rely heavily on the standby generator to satisfy customer orders. The 2020 national budget presented by the finance minister yesterday prioritizes job creation, which relies on formal employment opportunities and entrepreneurship. A fiscal incentive, the Youth Employment Tax Incentive, is being introduced to support employers who generate jobs for young job seekers. The tax incentive will reduce the employer's cost of hiring young people through a cost-sharing mechanism with the government. To operationalize the incentive, the Ministry of Finance and Economic Development will work closely with ZIMRA and other relevant organizations. Thank you for watching. Stay tuned for our discussion on the budget.
Climbing to the top takes more than just hard work and smart choices. It's the passion that drives you from within, the endurance to keep going through difficult times, and having a very clear vision of how to succeed. That's what we strive for at CBZ. We're a diversified and innovative listed financial services group in Zimbabwe with a complete range of activities including banking, short and long-term insurance, asset management, and property investments. CBZ has been a pinnacle for stability in the economic landscape of Zimbabwe, stemming from our deep-rooted values, our excellent customer service delivery, and our corporate vision to strive for excellence as a global competitor. Our continuous investment in research and development will cement our promise to provide customer convenience utilizing state-of-the-art technology. Relationships are at the core of what we do. We understand, however, that strong, long-lasting partnerships are not built overnight. With over 3 decades of wealth management, we have come to understand our clients and their specific investment requirements. Our unique mix of skills ensures that investment opportunities are examined from all perspectives. The balancing rocks of Zimbabwe have weathered the elements for thousands of years and stood the test of time, like majestic reminders of the fine balance of nature. They challenge our perception of what is possible and what endures. Just as CBZ has weathered the economic storms and remained steadfast throughout the turbulence of unsettled economies. Achieving the impossible through resilience and stability, we balance the elements of hard work, dedication, and experience, making us your ideal partner for success. Climbing to the top takes more than just hard work and smart choices. It's the passion that drives you from within, the endurance to keep going through difficult times, and having a very clear vision of how to succeed. That's what we strive for at CBZ. We're a diversified and innovative listed financial services group in Zimbabwe with a complete range of activities including banking, short and long-term insurance, asset management, and property investments. CBZ has been a pinnacle for stability in the economic landscape of Zimbabwe, stemming from our deep-rooted values, our excellent customer service delivery, and our corporate vision to strive for excellence as a global competitor. Our continuous investment in research and development will cement our promise to provide customer convenience utilizing state-of-the-art technology. Relationships are at the core of what we do. We understand, however, that strong, long-lasting partnerships are not built overnight. With over 3 decades of wealth management, we have come to understand our clients and their specific investment requirements. Our unique mix of skills ensures that investment opportunities are examined from all perspectives. The balancing rocks of Zimbabwe have weathered the elements for thousands of years and stood the test of time, like majestic reminders of the fine balance of nature. They challenge our perception of what is possible and what endures. Just as CBZ has weathered the economic storms and remained steadfast throughout the turbulence of unsettled economies. Achieving the impossible through resilience and stability, we balance the elements of hard work, dedication, and experience, making us your ideal partner for success.
host Rumbidzai Goredema and our chief analyst Respect Kwenzi for a discussion on the 2020 national budget. Respect, the key allocations of the budget are focusing
is to try to induce a bit of demand into the economy. And government is doing so by trying to expand its budget. If you see the 2019 budget, it was about 18 billion. Of course, they're now saying they're forecasting that expenditure to be up to about 25 billion. But they're also expecting their cash flows up to year end to be somewhat just above 20 billion. So if you're seeing an expenditure level coming from 25 billion to 63 billion, in nominal terms, that's quite a huge amount in terms of, in just explicit terms, just getting from 25 to 63. But if you then look at any kind of economy that is trying to reintroduce demand into its economy, they always focus on certain sectors that can easily accrue or that can easily drive growth. And infrastructure is definitely one of those projects, one of those sectors. And I think an allocation of that much specifically to the energy sector, it's actually meant to re-stimulate the economic growth through provision of electricity, which is quite key in production. But I don't think that the construction, because it's actually going to one entity, which is Wange, and they're constructing unit 7 and 8, and also trying to refurbish the other units. But I don't really think that focusing on energy can easily result in quick jobs, because what can stimulate growth is demand. And demand is when people get into shops and they buy things, and companies also start to produce, and therefore there's a multiplier effect that's coming from a certain industry. And this normally comes from sectors such as road construction. If you could talk of that, you find that it's a number of people that are getting few bucks, but they are able to then go and spend that money in shops, and that money drives companies' earnings. Companies also try to increase production and so forth. But this specific allocation to the energy sector is targeted at pushing the current deficit further lower, because we are currently experiencing an acute shortage in power, and that's quite crippling to the industry. I'm sure we've seen the results that are coming from industry, and they're showing a sharp dip in production or in sales volume that's partially attributed to low power generation or low power provision in the economy. So this is what government is trying to solve by ensuring that all inputs that are necessary for production to happen are in shape. But if you're looking at a growth of 3%, I think that's a revision from the initial projection of 4.5%. And there's a clear realization that next year is not going to be a very good year because of the kind of decline that we experienced this year. From my own projection, I don't even think that we will be able to even post a positive growth in the coming year. Why? Because there's still raging inflation in the economy. So in real terms, if you were having $1,000 in your pocket and inflation comes, it means that that 1,000 is further eroded. It's now possibly 6 or 5, which means what you're buying, actually when you're looking at the value of your money in terms of what you're buying, you're no longer able to continue to purchase goods.
Relying on subsidies. And now the minister mentions that some subsidies are going to be scrapped off from wheat and maize. And although they mentioned that they're going to keep on subsidizing on basic commodities such as milling meal, cooking oil for like the normal person who's underprivileged, who cannot afford much. How is the scrapping of subsidies from maize and wheat going to affect industry and even those who can, who need to import their own products and stuff?
Yeah, so I think when you're looking at subsidies by their very nature, they are meant to cushion the populace, and that is me and you, and not necessarily the companies. So I think what's to keep prices low, or so as to possibly make sure that the exchange rate remains stable. So now by removing subsidies, you are not affecting the end player. you are affecting the producer. So we have producers. In this case, we have maize producers. So the kind of model that we have in Zimbabwe is such that when you produce your maize, you take it to GMB, and GMB then sells it to millers. So they had a price tag that they were paying for a certain amount of maize. So suppose it's 2018 and you've got an import parity price of $250 in US dollars per ton. And they were paying more than that. They were paying 390 initially. So rather, you are paying more in USD terms ahead of what it costs to import. So in other words, you are giving a subsidy or you are giving an incentive to the producer. And they will take that maize and take it to the market at a price which is lower than 390. And they were selling it maybe at 260 thereabouts to the to the processor or the miller. So the subsidy was affecting the person who brought their maize to the market. So by removing subsidy at that point, it simply means the farmer can no longer find it viable to keep on producing their maize. That is, if affecting the production of that crop, sell cheap. So if you are not producing more per ton, it simply means your cost per ton, you have to push our own farmers to a level where they can actually compete with those guys so as to keep their costs low. Why? Because the market, and when they borrow, that's how we see money supply going up and all those problems of yesteryear, your serious deficits and so forth. So that's about maize. One other key product is bought at an exchange, at a favorable exchange rate, which is below market. So suppose today the exchange rate is at 15.9, we'll give you forex at 14.9. So rather, you have to also reduce your cost when you bring that flour to the market, or when you then produce the bread, and the prices on the shelves have to reflect a lower price so as to make it affordable to the end person. So if you are removing subsidies completely, it also means that these guys are now buying at market. And when you are buying at market, no one should come and tell you what price in terms of those products that are imported. And these are mainly soya and also wheat. But for 2020, we're going to import most of our maize. So that means maize is also going to fall into that bracket. And this is where I think the disaster will come in. So we're likely to see a sustained price increase. And we're getting into a drought here. And that means prices have to go up.
We'll go to the contentious subject, command agriculture.
Sure.
It has been facing some irregularities concerning payments, and we see that Sakunda is at the center of this subject, referring to the public accounts that have been held. The minister say that the command agriculture is going to be shifted from being government-led to being led by the banks, but still the government is involved since it should be granting guarantees to these banks. So what is the implication of this shift that the minister stated in the budget?
Yeah, I think you've made some good observations to say, if you are providing guarantees, then that means at the end of the day you're going to cater for whatever losses come through. So in other words, you are not incentivizing me, or rather you're not pushing me to do my best. The only way you can guarantee somebody that once they do something and they fail, they have to live up to it or to bear the consequences of failure. That's only the instance when somebody can fully give their best effort to doing something. Same thing goes to command. So command is simply a way of funding agriculture that was introduced by the Zim government a few years ago. And it entails giving farmers inputs to produce maize and some other crops, and then at the point of harvest, they then bring the products to government. They get a higher price, like we have just said, to say they are bringing the produce which is supposed to cost 240, they are getting 390, and that means they're actually getting more for the produce that should get them, that should have given them less. So now the problem now with banks is that banks have always been worried about security. They want to fund the sector, but they are worried about the security in terms of giving loans to the farmers. Why? Because all land in Zim belongs to government. And therefore, if a bank is loaning out to a farmer A and farmer A fails to pay, they cannot seize real assets. So banks have been using an incremental investment to the land or incremental upgrades to the land as a way of investing, to say, okay, fine, you've got 30 harrow discs or whatever farming implements that you have, and then we can value this, and then we can give you some money such that when you fail, we can then repossess A or B or C. But that fact, I think, rattles bankers to say, if all land belongs to government, then government decides to repossess your land in the middle of the farming season. What does it mean to me as a banker who has given you money? Because all land can be taken at any given point. Remain skeptical about the sector, and therefore that means funding for that respective sector might remain low. But some of the ways that have been proposed by industry are to say, if a bank can give a farmer a loan, and then they can then get to source markets as well for the end product, like what's done in tobacco. You've got funders from China and UK. They come in and they fund the whole process of production, and then at the point of delivering the crop, they then take the crop and they already have got markets for that crop. So that makes it easier for you to know, if you know the value chain and you also know the end to the end person in that respect. But in this way, I don't believe that the kind of agricultural structure that you have in other crops is quite workable.
So among the factors that the minister mentioned, in order to develop and grow the economy, there is the issue of foreign re-engagement. And current trends or current statistics show that Zimbabwe is the lowest FDI in the region.
Sure.
Compared to countries like Mozambique and Botswana.
Sure.
With the policies that we have and the current situation that we have in the country, can we say that our environment is open to lure investors, or what can be done to improve that?
Yeah, so I think that has remained quite a subject over the past few years. We haven't been able to attract much capital, but I think it has a bearing on the politics of the day as well. I think investors always shy away in highly politically charged economies, but of course you could name some. There's Venezuela out there. They're quite not stable at the moment, and you have got North Korea. They have quite some serious challenges at the moment, and investors definitely don't put their money where there's such. But I think corruption has been identified as one of those key issues that drag Zimbabwe in terms of trying to attract new flows. But there was quite some interest in 2017 actually, when the former president left power, and a lot of prospective investors came in. So there's value in this economy. There are a lot of opportunities that are out there, but they have not been fully exploited because investors do not trust the government, they don't trust the processes that we have, and they don't trust that their money is safe. So I think it's important to deal decisively with things like land in terms of title deeds. It's also important to deal decisively with issues to do with property rights, and also to deal decisively with the politics of the day, and also to deal with corruption. I think those are some of the hindrances and the drawbacks that we're facing in trying to lure capital into the country. And you've rightly picked that the region has been moving ahead of us. It's high time that we now put all these issues behind us. We need to move decisively on some of the issues like corruption, politics, ease of doing business, and so forth, so as to attract foreign direct investment. But I think another key aspect there is we always try to look outside. I think there is a lot of enterprise that's going on in Zim, but it's at micro level. It's a lot of your medium to small enterprises. If you go to Mbare, Siaso, you find a lot of serious enterprise that's going on there, but it's disorganized. These are people that needs to be put in groups. They need to find scale. They need to be put mainstream economy, and they can actually do better things for the economy. I think those are some of
them showing their abilities in regards to the ICT department, that these elderly people are deemed not to have and this is called the Youth Empowerment Tax Incentive. So what are the odds that this is going
to give given opportunities? But in terms of the real play, I think my deduction would be that when you have a small cake within yourselves, it's always difficult to share a small cake. So shrinking in real USD terms. I'm sure we're talking of a lot of growth rates in terms of revenues and so forth, but companies themselves, they know that their profitability has gone down. So if your profitability has gone down, what you have to do is to masses. And we are at a time where companies are actually closing. Some are scaling back, some are actually cutting down in terms of their production time. So you find that a company that was operating for environment to operate, any enterprise can thrive on that. And anyone who makes an evaluation to employ can make that evaluation based on their ability to play in a field that's quite stable, to hit a wall in terms of trying to realize real gains from that.
Well, on the issue of ICTs that you mentioned, with the youth being the ones who are very much well versed in that
point that I was mentioning, in order for you to speed up your innovation, your adoption of these ICTs, you have to have capacity. So what we need is capacity. If you look at other economies, the reason why there's a lot of innovations going on in the United States, to create or to be creative and innovative, they need to have a stable mind, and a stable mind actually means that you're in a stable economic environment. If you know that your fees has not been paid, you don't have anything to eat at school, it actually affects your level of innovation stability, and we don't have that stability. Therefore, anything else that we try to do might actually end up in vain.
Well, we'll see what we get from the national budget to see if their policies are just fantasy or if they'll come to pass.
Sure.
Thank you for joining us for the show, sir.
Yes.
Wait, before we close, there have been reactions from the public on the issue.
So obviously I've also gone online and I've seen the various reactions. It's quite predictable when you're in an economic downturn that people get to be so reactionary, and even their reaction gets to be that bad. Why? Because we have been stretched enough. I mean, everyone is quite hurt, everyone is not patient with the government and so forth. But I think just that you must to look at that. Of course, we might not have the immediate funding, but that kind of imagination is encouraged. But priorities really, it's important to have your priorities right, because if you are having a lack of basic amenities and so forth, and then you imagine something bigger, I think it's quite misplaced priorities, because if you pay for the minister.
Well, that's it.